Welcome back to the channel of Truth, Trust, and Transparency. Today, I wanted to record a super sharp and simple video on how negative gearing actually works, and I want to use a real life example so that you know and you'll be fully across the entire concept and know the numbers behind it when it comes to an investment property. Now, obviously, you're going to hear good things about negative gearing, you're going to hear bad things about negative gearing. It is my opinion that nobody invests with negative gearing as a strategy. It is purely a tax outcome. We obviously are investing in an asset to increase in money, not to lose money and be able to claim some of that back. So all those people that say, scrap negative gearing, it just tells me that they don't understand the concept fully, and you'll probably see why by the end of today's video. So this is on the assumption that you've bought a investment property, because obviously you can't negative gear your primary place of residence or the home that you live in. So let's run through it quickly. Negative gearing works on the income and the costs of that particular property over that financial year, and how that's calculated. So for that $450,000 property, if I've put a 10% deposit down, I've $45,000 deposit, that means I'm left with a loan size of $405,000. Now, why that's important? A $450,000 property, in this particular instance, I have assumed that's going to rent at $450 a week. $450 a week, I've had it rented out for the 12 months of the year. It means I have received income from my tenants to the tune of $23,400. Now, that's the income. The expenses of holding that investment property for that particular year, I'm going to, and in today's, at the time of recording, interest rates are about 6%. Especially for investors. 6% is my interest rate, interest only on a debt of $405,000. Obviously, $450 minus the deposit means we're left with a balance of that. We've paid 6% of $450 for the entire year, means we've paid $24,300 to the bank in interest just to hold that property. Now, some other fees and some other costs that will come out in a 12-month period. Obviously, when I'm letting the property, maybe there's a bit of maintenance, some things fail or there's some issues. $1,400 goes to the property management fee. So that's 6% of the rent. So obviously how that works, when the property manager takes that fortnightly or monthly rent, they take 6% as a management fee. We've paid insurance on the property, we've paid council rates, we've paid water/sewage or a portion of that, and we've probably paid some other expenses that, advertising fees, lease preparation fees, and admin fees that relate to the property management. So at the end of the financial year, as a property investor, our property manager would have taken care of all these expenses. They will send us our end of year financial summary statement, which will have these costs down there. The only thing that you will need to then add on is obviously the interest you've paid to the bank. And in this particular example, my total costs for the year, which is $24,000 plus these costs here, equals $33,150 in costs for a property that is only bringing in $23,400 in rent. So as you can see, this property is negatively geared. Why? Because the costs are more expensive than the rent that it's bringing in, which means the property is costing me $9,750 per year, or $187.50 per week to hold that property over the year. Now, what happens when I give this to my accountant at the end of the year? I say, look, this is the rent or the income. If you think of property and this sort of P&L, this as sort of like a P&L statement, you say my property had an income of 23, had expenses of 23, I'm in the negative 9,750. Now, how that works on top of your income. So let's just say you earn $100,000 in income per year. In the 2025 tax year, you will pay about $22,788 in tax. However, we know that this is not income, because whether this is a plus or this is a minus, it is added to your income for you to be taxed at. So think if it was the other way around and it was 10 and 9,700 on top, that'd be added to my income that I need to pay tax on. because it's another source of income. At this current moment, because it's a negative, that means my taxable income actually goes down to $90,250. Now, here's the thing. My PAYG, the job that I go to, my 9 to 5, because they think, and the contract that I have with them is that I earn 100,000, they've been taxing me at the tax rate that they should have. So technically, at the end of the financial year, I've paid $22,788 in tax. However, because of this shortfall, it means my income actually decreases to $90,250. Now, if that was my income with my PAYG, the company that I work for should only withhold $19,668 in tax. But instead, I've actually paid this much tax. Now, because my income is less, it means I actually pay less tax, obviously. Now, there's a discrepancy between the two. I was earning 100 grand and I paid that much in tax. However, because my property is negatively geared, that expense comes off my income, and that means I should be taxed at this amount. So the difference between the two, because I've already paid that in tax, means 22,788 minus 19,668 means at the end of that tax year, I will actually get a $3,120 tax return. So that means that instead of it being a $9,750 cost, I actually take away $3,120, which means it's actually only cost me $6,630 to hold that property. That's what negative gearing is. Negative gearing means getting this amount back because the property is in a negative. Now, I always say to people that have an issue with negative gearing and want to abolish it, the one question I ask them is, okay, well, could we abolish positive gearing? If I can't take this as an expense of my income, then let me not pay any tax on anything that's positively geared. And then they go, oh, no, but can't have your cake and eat it too. You can't have one and not the other. So obviously in this circumstance, people say that, oh, ban negative gearing. The whole idea of this, I'm not doing this to get a $3,120 cashback. That's not why I'm investing in property. I'm investing in property because if a $450,000 house increases at 7%, I've made myself $31,500 in capital growth in year one alone. Now, obviously, as that amount compounds and it grows and grows, that amount per year will get bigger and bigger and bigger. But that's the reason why. I've made $31,000 in growth, and it's cost me $6,000 to own. So at a multiplier, it's 5x the amount. So I've put in, essentially it's cost me 6,000 and I've made 31 on it. So 6 times 5, we're almost at the same amount. That's negative gearing in a nutshell. And it's also why I don't believe negative gearing is an investment strategy. Negative gearing is just an outcome of these expenses. You know, if my interest rate changed and it was down to, 2%, that'd be positive and I'd be paying tax. And you wouldn't hear from anyone. But when I first buy the house and at 6% interest rates and with a 10% deposit, you can't help but have the majority of properties, even at a 6-7% net yield, they're going to be negatively geared until the rent starts to increase and interest rates come down to a more palatable, normal number, potentially starting with a 4. Will this number here start to creep towards 0, which means if it's neutrally geared, I am not out of pocket, nor do I get a refund. But negative gearing is essentially, in a nutshell, when the costs to own the property or hold the property for the year are larger than the income that it brings in, which means the difference is offset off my income, which means I would have paid more tax because I've got the higher income, and then so I get back at the end of tax time the difference between the tax I have paid on my high income versus the tax on my income that is adjusted after I put in the costs of the investment property. Negative gearing 101, short and sharp. Any questions? Let me know in the comments.